Welcome to this month's Economic Update. I'm Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by our Senior Economist, Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, it was another solid month of performance for offshore markets. Can you walk us through how the various regions performed?
Yes, well, the standout was America. So the US share market was up about 0.5%. So if you looked at the Standard & Poor's 500 benchmark index, it made record highs in September. Now, European shares also did quite well. They were up 0.5% in a similar performance, but they've been lagging Wall Street over the last year in particular. And actually Asian shares, some of the Asian share markets bounced back as well. So you had the Chinese share market, if you looked at the Shanghai index, was up 3.5%. So a good solid performance for September.
So interesting that you mentioned that the Chinese market performed quite well, because that was on the back of quite a few negative months on the back of the trade wars with the US. What's the latest on that?
Well, President Trump announced tariffs on another 200 billion of imports from China. So that adds to the 50 billion that he initially announced back in May. So what we had is an escalation of the trade tension. But from the Chinese share market's point of view, what's helped the market rally is essentially lower interest rates. So the central bank appears to be pumping in liquidity into the financial system to support borrowers and to support the banks. So that's helpful for the share market.
Okay. And turning to the US, we saw the US Federal Reserve, or their central bank, raise interest rates as expected. What impact has that had, given the rise in bond yields, increase in borrowing costs? What impact has that had on markets?
Well, it hasn't dented Wall Street. So Wall Street is still running on the corporate profit story being so strong. So expectations for the September quarter are that profits will be up 20%. However, what the Fed is actually signalling is some concerns about future inflation risks. So that's why they're essentially raising interest rates at the moment. And what they can see is that both by a combination of higher wages, but also higher oil prices in particular, they're seeing that future inflation might be a problem for the United States. Now, for now, the Fed has indicated that their interest rate rises will be gradual, but the bond market is starting to tell us some concern there that maybe the Fed will have to be more aggressive in raising interest rates.
You mentioned oil prices there. There was an escalation of oil prices in recent months. What's behind that?
Well, the main impetus at the moment is sanctions on Iran. So Iran exports around 2 million barrels per day. So if we think of that, it's about 2% of global oil supply. So if we get that shifted off the global oil market, there's a potential shortage of supply. There are also concerns about the American shale industry, whether it can continue to produce very strong supply. So that combination of Iran plus the US shale industry indicates there may be a shortage of oil.
Finally, Bob, looking domestically, what about the Australian share market? It had a negative month for September.
Yes, Australia's disappointed in September, and it was down about 1.2%. So it's only a mild negative return. But what we actually saw is some of the sectors that did well during the year, such as healthcare, which was down 7%, utility sector was down 3% for September. So it was a bit of a pullback in terms of performance. Against that, we saw better returns out of the energy sector, so that reflects the higher oil price story, but also resources. They did quite well. We've seen iron ore remain quite resilient over the past year compared to all these concerns about Chinese trade.
Thanks for your time, Bob, and thank you for joining us.